Welcome to the Investing Podcast presented by Tusk Media. This is Outsider Trading, an audio and video deep dive into the people, places, and things that we find most interesting in the market.
Hey everybody, welcome back to the Investing Podcast presented by Tusk Media. Andrew Hall here, Ben Nye. Ben, how you doing, man?
I'm doing well.
Very good, very good. Before we get going, give us a follow on Twitter, shoot us a DM. We will send you one of these awesome stickers. You can put it on your car, you can put it on pieces of paper that you take notes on. You can put it just about anywhere. Bottles, you name it. Really cool stickers, totally free. Don't have to pay postage, don't have to send us cereal tops or anything like that. So free gear. So give us a follow at Tusk Media LLC. Today, we're going to jump right in. We're going to talk about Citi. So, Ben, starting off talking a little bit about strategy and the 4 S's. What are the 4 S's for Citi?
Yeah, so when Mike Corbat came in as the CEO, he took over from Big Cap Pandit. His strategy was say simpler, stronger, safer, and smaller.
Almost tripped him up on that 4th S. So simpler, safer, stronger, smaller. What about smarter?
Smarter. They did not do smarter. IBM is more intelligent now, but Citi is not more smarter.
Yeah, they can pay us for that idea.
Yeah. So 4 S's from Corbat, all coming down to the fact that they want to get back to banking.
Right.
Everyone talks about Mike Corbat being the first real Citigroup CEO who was actually a banker. The others kind of like managers, or they are working in the securities division. Vikram Pandit was on the international securities division, and Corbat is really a banker at heart. Mm-hmm. He rose to prominence actually in control of Citi Holdings. So what happened was in, I think it was 2010, Citigroup was just a mess. They had all these assets in all these different locations, $800 billion in assets, almost $1 trillion in assets that were just junk. So they put it all, I unloaded all of this junk into this new entity that was still under Citigroup called Citi Holdings. And basically what they wanted was someone to come in who would basically make this business die a slow, painful, but not too painful death. They wanted
but not too obvious.
They wanted this business to just go away. And so what you have now is it's $75 billion in assets, and it's actually ran a profit. So first time it ran a profit since the crisis. So Mike Corbat was brought in to do that job, and his wife actually joked to him at the time, you're actually taking an interim position for a position that'll probably that's not even a permanent position.
If you do a good job, this goes away.
So, but he was ultimately promoted to CEO. So now he's doing a similar thing with the company as a whole. He wants to make sure that where they are located, they are profitable. This is in stark contrast to Pandit's philosophy, where they wanted to be number one in absolutely everything, almost regardless of profit. Mm-hmm. So what you have now is you have this global bank that's actually smaller in size than a company like JP Morgan or even Wells Fargo, who are primarily, and in the case of Wells Fargo, exclusively located in the United States. And yet Citigroup is smaller by assets, but more global. So Citi still thinks that's a competitive advantage to have a lot of assets in Mexico, for instance, and in India. But that's kind of where we are today in Citi. So a much smaller company with less of these bad assets.
Mm-hmm. So how's that playing out in particular? Looking at recent earnings, things like that. Is the story starting to vest itself in a positive way? Because obviously there's a huge emphasis on strategy and execution here. Because to go smaller, but also kind of expand your geographic footprint or maintain that, you got to bat a pretty high percentage.
Right. So I look at a couple things for evidence of this. First is the efficiency ratio. The efficiency ratio is on par with JP Morgan and Wells Fargo and superior to Bank of America. It's in the high 50s right now, and they want to get into the mid 50s, between 50 and 60, which is impressive to me that they can keep operating expenses that low when they are in such a wide diverse set of locations.
Mm-hmm.
I also like to look at return on assets. I think return on assets is a pure way of looking at the business and seeing actually how the managers are managing it than return on equity, because when you look at return on assets, you can always lever that up.
Mm-hmm.
But if your return on assets is poor, you're going to be levering up a poor base.
Right. It's going to show.
Yeah, so I like to look at return on assets, and what we've seen is that, and this will be on the screen, but return on assets has gone from 0.6 in 2010 to 0.84 in 2016 year to date, which is closer to the likes of JP Morgan and Wells Fargo. And again, better than Bank of America. And I was actually up above 1 last year in 2015, but that was primarily because like a few one-time things.
Mm-hmm.
But you are seeing overall, you take a step back and you're seeing that trend upwards. And part of that's due to, they're getting rid of they're shedding a lot of those bad assets. But what happens is when you do get smaller and you become a bank that you can actually get a grasp on,
Mm-hmm.
then you can start to utilize those assets a little better and look for ways to grow. And I think that's what Citi is doing right now.
Mm-hmm. Mm-hmm. So, you mentioned kind of getting a grip on it. Obviously it seems like this would make them less prone to some of the troubles that companies like, say, Wells Fargo have seen
Mm-hmm.
recently in terms of accounts and even getting a grip on what exactly happened or what the scale of the issue may have been. So they're in a good position there. Talk a little bit about the global play specifically, how that's panning out, and what you see in that, kind of in the future in terms of how they continue to maintain that.
My initial reaction is that this is not a good strategy
Right.
to have
Yeah,
to be in 100 different countries.
It's totally counterintuitive.
Especially with, it's not like you're making Coke. It's not like you make
Right.
a can of Coke that you can just rebottle and
Mm-hmm.
sell to 100 different countries. You're operating with different regulatory regimes, with different capital requirements,
Different
with different clientele. And so, I don't know how that actually scales, but based on the return on assets, that somehow is actually happening. What's impressive to me is that Citigroup has actually paid out less in fines, according to Bloomberg data, than both JP Morgan and Bank of America. And also, if we look at earlier this year, Citigroup was the only company whose living will, they have to submit a living will to the Federal Reserve, was actually passed. Wells Fargo did not pass, actually. So Citigroup has really ingratiated itself to regulators, and I think that's actually accrued to the benefit. Now, the global strategy, I think, has yet to fully play out.
Mm-hmm.
We've seen relatively weak growth in Mexico, relatively weak growth in emerging markets overall, with the downside in the commodity cycle.
Mm-hmm.
Should that stabilize and start to grow along with the demographics, I think that Citi is actually in a very good location
Mm-hmm.
in order to take advantage of that. Of course, they do have to play against local competitors,
Right.
so it'll be interesting to see how the competitive dynamics of that play out. But I think what you're seeing at Citi is something that is really unique among the U.S. banks, because it does have that global play. And you could argue that if the U.S. starts to decline, that diversification will accrue to Citi's benefit over time.
Right. Right. So overall, sounds like a pretty optimistic story here.
Yeah, when I first started looking at Citi in depth, I was not so sure about it, because we're doing a big review of a lot of different companies at the end of the year now, and the stock had obviously run up a lot. I'd actually be raising my numbers on it quite significantly, and the reason is I don't think that Citigroup will approach JP Morgan's multiple to tangible book value, for instance, anytime soon. JP Morgan trades at 1.6 times book, Citigroup's at about 0.9. But I do think that as you see that asset utilization start to improve, you'll see the valuation approach some normalcy. What's interesting is the lack of asset growth they've seen. So if we're comparing Citi and JP Morgan, annual asset growth at JP Morgan is 4.3%. Annual asset growth at Citi is 0.54%. So there's a big disparity there, and you should think that Citi, being levered to more faster, more dynamic economies, could actually grow that asset base more rapidly. And that's where you really see the explosive upside. Even so, I think a move to 70 would not would not, would still be in keeping with the move we've seen in JP Morgan, for instance. And I think that Citi is one of the more attractive large banks in today's market.
There you go. So Citi, keep an eye on it. Continue to watch those things. Smaller, simpler, safer, stronger, smarter. All 5 of those things. They're 5 for 4 potentially. So keep an eye on that strategy as it continues to play out. And again, kind of a counterintuitive story in a lot of ways. When you think smaller, you don't think global expansion.
Right.
So definitely something to kind of keep an eye on. We do own Citi in a lot of portfolios, so we like the stock. We'll continue to hold it. Y'all have a great day. We'll talk to you soon.
Tusk Media is a subsidiary of Narwhal Capital Management. Ratings and reviews of Tusk Media content are not to be construed as endorsements of opinions, analysis, or services offered by Tusk or its parent company. The opinions and predictions shared here are our professional beliefs at the time of publication. We are not under duress from any of the corporate entities mentioned. This is not a solicitation to take any particular action. Although we are investment advisors, this information should not be considered investment, legal, or tax advice. We strive to be as impartial, insightful, and accurate as possible. We base our opinions, analysis, and calculations on information we believe to be reliable, but we cannot guarantee its accuracy. We can, however, guarantee that our opinions will sometimes be flat out wrong due to a variety of factors. Employees and clients of Narwhal Capital Management may or may not hold positions in the securities detailed and may or may not hold these positions in the future. A full list of all securities purchased, sold, or held during the 12 months preceding the date of this publication can be provided upon request. Unless otherwise noted, all data accessed via MarketWatch or the Bloomberg terminal. Past performance does not guarantee future results. A copy of Narwhal's Form ADV is available at the SEC's website, www.advisorinfo.sec.gov, or from Narwhal upon written request.